So, I mean, of course, you got to read between the lines of some of these headlines coming through from Apple, but we've seen kind of a line of these companies now talking a bit about tax reform. The banks certainly seeing that this in the long term could be good. Should the president be patting himself in the back on all this? That, you know, this 3% growth he's promised, is it really going to be coming?
Well, our forecast is about 2.5% for both this year and next, so it's not quite at the 3% level that one would like. It's also worth bearing in mind that 3% itself is not a particularly ambitious target, given that the US was growing at
2 straight quarters of
or
it,
so.
yeah.
Well, back in the 1990s, it's growing much more strongly than 3% a year. So at the end of the cycle, 3% is no great shakes, really. And I think as far as the tax reform is concerned, one should think about it really in terms of international tax competitiveness. One of the problems that the US has had is that European countries have been slashing tax rates, corporation tax rates, over the course of the last 20 or 30 years, a kind of race to the bottom with regard to corporation tax. And the US is kind of trying to make up for lost ground. Now, it may be helpful in terms of repatriating dollars into the US from elsewhere, but the big question really is, will companies start to invest in a big way? And globally, investment still remains pretty weak compared to what we typically see at the end of a cycle in a decent, strong upswing.
Right. I mean, even before this tax bill was approved, companies were already hoarding a lot of cash already. It wasn't the lack of it that caused them to not actually spend on CapEx. So what's going to really trigger them to do so now?
Well, part of the issue actually is technology. The technology is coming in a way which is actually changing the bargaining position of capital versus labor in the US and indeed elsewhere.
Yeah.
You can see this in terms of downward pressure on wages, that you can use technology to hire people by the task or by the hour rather than by the annual salary, for example. And that means that the bargaining position of companies versus labor has gone up dramatically. So what we're tending to see is expansion coming through via hiring people rather than through investment, which is fine from the point of view of corporate profitability, but it's not such good news in terms of investment, it's not good news in terms of productivity, it's not really good news in terms of long-term growth. So plenty of jobs, but they're pretty low-paid jobs.
Oh, I was going to ask about wage growth. I mean, we've seen several companies already adding bonuses. I think Apple just announced it, Walmart raising the minimum wage. Does that add any kind of inflationary pressures to the picture at all?
You know something, it's interesting that wages have been a worry for quite some time now. The unemployment rates in the US are very, very low.
Yeah.
But again, the actual underlying wage pressure is very minimal compared to what you'd normally expect to see at these kinds of unemployment rates. So the old-fashioned Phillips curve, this idea of a trade-off between unemployment and wages and inflation, it's not really working very well anymore. It comes back to this issue of technology, that technology is driving wages down, and lower wages create more jobs.
But I mean, do you think it's actually dead, Phillips curve, or some are saying it's reawakened? Because if we see unemployment below 4%, it's going to be much more pressure here to actually see inflation pick up in a big way this year. And
people said below 5%, below 6%. I mean, it's always a moving number. I mean, obviously, there's at some point there may be a number whereby things begin to kick in. The surprise so far has been that the decline in unemployment to date has not given the wage increases that people really had already expected.
You know, Stephen, speaking about wage increases, Loretta Mester from the Cleveland Fed, she's speaking at this moment to reporters. We're going to talk more about it with Kathleen Hayes, but she says she sees upside risks from U.S. fiscal policy and that labor shortages are more widespread than reported. So would you agree that there is the chance that we're going to see more upside risk to the fiscal policy right now in the U.S.?
Well, to the extent that fiscal policy is more expansionary, then other things being equal, that would mean higher demand. Higher demand means lower unemployment, and that could mean higher wages. But I think it's again important to put this into context. HSBC's forecast is growth of about 2.5% for this year and next. It's not really exciting growth. It's not particularly impressive. And under those circumstances, I think the chances are we're going to see not much in the way of wage increases. Central bankers, policymakers have to worry about this sort of things. They're always worried about risks rather than central views. But the big surprise so far from the Fed, indeed from other central banks around the world, is that even though unemployment is low, wage increases are not really kicking in. Inflation is incredibly well behaved.